So here are some strategies to maximise your future post-tax wealth. Now you may be, I don't know what stage you are at in your property career. Maybe you are just starting out, or maybe you've already got a vast portfolio. But even if you're just starting out, a lot of people just carry on. The hardest thing is actually to buy your first property. Then, as the effect of inflation just means that properties will go up in value over time, which means that you will then get equity, which you'll be able to draw down and buy new properties. So a lot of people go on to actually build quite large portfolios. That could be you at some point in the future. So it's very important to structure things properly right from the start, when it's very cheap and easy to change your structure. So this may not particularly be relevant to you now, but looking forward, 10, 20, 30 years, you'll have really wished that you'd have paid attention to a video like this and structure things properly. Anyway, without further ado, let's carry on. So one question that people ask is, should you sell or keep long term? Because there's pros and cons of each, and some people say you should never ever sell, whereas some people are quite happy to just flip a lot. It is a good question. Now, one thing that the people who say you should never sell look at is all the costs of selling and buying. So SDLT, stamp duty, you have to pay when you buy, and CGT you have to pay when you sell, unless it's your main principal permanent residence. So that would imply don't sell it, just keep it, because then you would avoid having to pay those taxes. But on the other hand, you may have a lot of equity tied up in a portfolio or in some properties that you could be used more profitably in something else. Maybe something's just come on the market below market value, which you could refurb and flip. So you'd be better off in that case possibly just selling and using the equity in that case. So the only way to really decide is to do a spreadsheet like this. So I do these spreadsheets to make my decisions whether to buy, whether to keep, whether to sell. Everything I do a spreadsheet like this, and I look at all the inflows and outflows, and I calculate the internal rate of return. First I calculate it by month, because I look at all my future flows per month, expected flows, and then I convert that into the internal rate of return per annum, and then I just compare different strategies. What internal rate does it give? And just to give an example, on one of my properties, if I keep it long term, the internal rate of return it gives on my initial investment is 22% per annum, but if I flipped it after 18 months, the internal rate of return was 61%. So in that case, it would have been better to sell after 18 months. So the answer is not always to just keep long term. Sometimes it's good to sell as well. Another really important question is whether to own properties in your own name or in a limited company. Usually it's better, if it's a new investment property, to invest in a company because of Section 24 issues. So the question arises, what if you've already got properties in your own name? Is it best to just keep them in your own name, or how about moving them to your company? Now, one problem with that is you would have to pay capital gains tax, but there is this Incorporation Relief under Section 162, which is also known as the rollover relief on transfer of business. Now, this only applies if you transfer a business to a company. So it's got to be with all its assets, and the business is transferred in exchange wholly or partly for shares. So your property activities need to be substantial enough to be considered a business, which normally means you spend 20 hours or more a week on them. So that's something you consider, and obviously it's well worth going down that route if you, or it's well worth claiming that relief if you can, if you fit this. And the other thing is stamp duty. So if you sell a properties to a company, the company would normally have to pay stamp duty, but there are reliefs available if the transfer is from an established business partnership. Now, you have to be very careful about this, because if you there are these general anti-abuse rules, GAR, which can negate your efforts to avoid SDLT. So you can run into problems if your actions are contrived and you intended just to avoid tax. So there has to be sort of solid sort of business reasons why you might want to do this. And there's always a risk. There's lots of maybe people encouraging you to do these transfers who get a hefty commission, which look okay on paper, but it might be in a few years' time the Inland Revenue will just get a bit stricter, and they might look back at your activities in the previous few years and try and untangle things. So it's best to be get really good advice and to be very mindful of any risks of avoidance, that you don't push things too far. So, and the way to do that is to make sure you have a highly skilled tax advisor. Another strategy is to split income. So maybe close family members pay tax at a different rate to you, and maybe spouse, adult children, or aged parents, for example. And there's different ways you can split income. Deed of trust is maybe the simplest. Then you could just submit Form 17 to change the split of income to reflect the actual share of beneficial interest. Another way you can split income is to have a limited liability partnership. So you own a property in an LLP, and then you can own the property in different as a partnership in different proportions. Like you could own 70% of the property, and your son could own 10%, and your wife 20%, for example. Another way to split income is to just gift shares to a partner or other family members. So maybe there's 100 shares, you could just give your wife 30 shares, and then if it's a company, so that's another way to split income. And then she would get, in that case, 30% of the dividend, and she might be paying a lower rate tax than you, so that could save income tax. Now that's if you just have one class of share, it's a bit inflexible. But obviously you could, if you give shares to your spouse, there's no capital gains tax. If you give them to other family members, there is capital gains tax payable. So that's why it makes sense, if you're going to start giving shares around, it's best to do it right at the beginning, when you first set the company up, when the company has no value. And the longer you leave it, there'll be more CGT to pay as your portfolio grows in value. The gain, taxable gain, will also grow, and therefore the CGT will also grow. So if you're going to gift shares, do it as soon as possible. Now, the gold standard is the FIC, the FIC, or the Family Investment Company, which is where these have alphabet shares. These are extremely flexible, and they are really good for tax planning. So you can have as many different classes of shares as you like, A, B, C, D, etc., all the way up to Z, or you can have more than that. And each share, you can decide if it has voting rights, if it's a growth or freezer type share, so if it has a share in the growth of the value of the property or not, and also what sort of dividends. So it has. This is a something I prepared earlier. So, for example, you could have A shares, and they could have voting rights. B shares you could give to your spouse. C shares you could give to your son. D shares you could give to your daughter. E shares to your mother. And F shares you could give to a discretionary trust. You could keep all the voting rights. All the growth from this point onwards, when you do this, could go into the discretionary trust. That would sit then outside your estate, so there wouldn't be any inheritance tax on the value of the growth from this point onwards. You could just then decide who you pay. One year you might want all the dividends yourself. The next year, maybe your son and daughter at university, so you want to pay them dividends, and or maybe your mother needs a bit of financial help, so you could pay dividends to her. So it'd be up to you to just pay dividends to who you want every year. So it's a really great way of transferring your wealth to your family, or trust, or not. Don't have to be a family; they could be friends. So family investment companies are amazing, especially when used in combination with a trust and having freezer shares and growth shares. The discretionary trust, the assets held outside your estate and the estates of your bloodline, so they're not subject to inheritance tax or any type of litigation. So for example, put your assets into a trust, then maybe you die, or maybe you don't die. It doesn't really make any difference to the assets being held in the trust. And then if the trust would just act to help you and your bloodline, your sons and daughters and their sons and daughters. So if they got into any type of litigation, for example a messy divorce, and someone tried to sue them for all their money, or then it wouldn't affect the assets held by the trust. Very powerful setup. Lots of very rich people have this set up for good reason, and also as lots of property investors are finding out about it, they're realising it's actually a good thing. Even if you're not mega rich, it's actually a really good thing to set up, because it's cheaper and easier to set up while your portfolio is small anyway. So a FIC is can have all the growth in a class of shares owned by a discretionary trust. So are you sitting on a time bomb? Good question, because your portfolio will quite possibly just expand and expand and expand decades into the future. We don't know what's going to happen, but it's quite possible this will happen. It could increase in value, or you might buy more properties. And then what would be your CGT payable if you sell when you're old? You might be forced into a sale. Maybe your mortgage provider will say, oh well, it's too risky to lend to you now, you're in your 80s or 90s, so we're going to call our loans back. So then you may have to sell, for example, at that point. We just don't know what's going to happen in the future. And then will your estate be taxed at 40% of the equity inheritance tax when you die? So every day that you wait, your portfolio grows in value. The CGT and inheritance tax problems just get bigger and bigger, and much more expensive to move into an optimal structure. Now even Tory governments tend to like to tax landlords. Landlords are an easy target because numerically there aren't really very many of them, and they all tend to vote Tory anyway. So it's never, no one ever talks about helping landlords. So we sort of have to look after ourselves really. So things are probably going to get tougher in the future, in my opinion. So it's good to really take advantage of structures that are available now that may not be available in the future. So that's another reason to act now. So the best and cheapest time to set things up properly is now. The best time is actually when you started, before you bought your first investment property. The second best time is now. The third best is, or worst time to set up, is just leave it till sometime in the future. So a good accountant specialising in property tax can possibly save you a fortune in tax. Contact me for more information. We could just have a quick chat and see if we think there are ways we can help you save tax, and you don't really lose anything by doing that. So it's a free consultation, and it's good to just get a second opinion to compare it what you might have already been thinking about, or what your other advisors are telling you, because it could potentially open your eyes to new possibilities that could save your fortune. That's all for now. Bye.